FTX was 3 years ago, the industry, when you think about like the chairman of the SEC, Chairman Atkins, coming out in like July of this year and saying like, we're launching Project Crypto. We're going to figure out a way to make the US the home of digital asset innovation and tokenization. That to me is really impressive because I think any other industry in the world you could look at and say if something like FTX happened, it'd be over. Like it'd be done. And it didn't, like in the grand scheme of things, it didn't take that long for crypto to recover. And that to me is really exciting. And it just speaks to like the fact that there is a real global innovative force behind this industry.
Welcome to Tokenized, the show focused on stablecoins and the institutional adoption of tokenized real-world assets. My name is Andrew Van Aken, data scientist at Artemis, a crypto analytics startup. I would like to welcome you to Stablecoin Stats, a monthly show on the Tokenized podcast dedicated to the stats behind the stablecoin market. Joining me, as always, today is my colleague and friend, Anthony Yim, co-founder at Artemis. Sir, how are you on this fine morning?
Much better than a couple days ago. I didn't tell you I actually missed my flight back from to New York. I was just too engrossed in a. Actually, we were talking about stablecoins, and I missed the window by like 3 minutes. And they had the wrong gate on my boarding pass, and so.
Oh, sure. Blame it on the gate. Blame it on the chain. Blame it on the blockchain. Today, we are also honored to have Alana Levin, investment partner at Variant, who is fresh off dropping a 180-page report on crypto trends. Alana, an honor to have you. How are you today?
Doing well. Really excited to be on the pod. So thank you guys so much for having me.
Have you recently missed a flight? Are you punctual with your flights?
Sounds like I'm doing a little bit better than Anthony. I'm the type of person that shows up like 3 hours early to the airport. So, two ends of the spectrum.
That's good.
No, that's me usually. That's why it's even more painful that I missed it. I'm not somebody who misses flights. The last time actually I missed a flight was my internship to Microsoft as like a 17-year-old, and I was horrified because I was like, oh no, like they're gonna rug my internship because anyway.
All the memories. A quick disclaimer before we get into things. I need to remind you that the views or opinions of your contributors today are their own and do not necessarily reflect those of the companies they are representing. Nothing we say should be taken as tax, financial, investment, or legal advice. Do your own research. And lastly, before we get into the stats, I'm thrilled to remind you that this podcast is made possible by Visa and powered by Artemis. Alana, I would love to learn more about yourself. And yeah, I would love to have a quick background if you don't mind.
Of course. So I'm an investment partner at Variant. Variant is an early stage crypto native venture capital firm. I work as a generalist, so I've done everything from infrastructure to consumer to DeFi and quite a lot around stablecoins and payments. Sort of the lens through which I look at the world is anywhere crypto makes the world more productive gets me really excited. And I think stablecoins are sort of a leading digital asset in that way and a beachhead for all the other sorts of digital assets that we can get adopted. And so that's one of the reasons that I spend so much time on stablecoins.
I love it. Well, we're happy to have you. And you both were at Fintech NerdCon while I was just at home, just making the charts as always. Is Simon Taylor a genius for planning conferences in warm places during cold months? Anthony Yim.
Absolutely. Man, I could not wait to get out of New York. And we actually had our Artemis offsite right after, so it was very convenient.
This is true. I did actually join you for some nice weather. But I know both of you are frequent on the conference scene. Alana, what were some takeaways from Fintech NerdCon, and what was the attitude overall of the conference?
It was really interesting. Fintech NerdCon, I'd say, had probably like 30% crypto people and then 70% non-crypto. And the theme that tied the sort of two ends of the spectrum together was stablecoins and payments and all of the different ways that existing fintechs are starting to think about payments. One of the things that I think I just was really made clear during the conference is how much data exists around the layers of payments. So in the traditional system, when you move money from one country to another or one institution to another, there's probably a dozen different layers of data that get incorporated. And when you start to think about what that looks like on chain and sort of the new infrastructure stack there's actually quite a lot that changes. And so that to me was sort of one of the big thematic areas of like, how do we think about identity and tracking and transparency and all those sorts of metrics when you move on chain. A lot of it was really exciting, but I'd say sort of that was like my big takeaway of it's not just the money movement, but all the data that's associated with the money movement.
Interesting. Anthony, would you agree, disagree, or what was your favorite panel? Besides yourself, you can't plug yourself.
Darn it. Well, actually, yeah, my biggest takeaway is similar to Alana, actually. So I think that one of my favorite moments was jamming with Max Siegel from Privy, now acquired by Stripe, on just like how much more there is to getting stablecoins to work for payments besides just the pure like money movement ledger layer. And specifically, and we'll talk a bit more about this later, on having to retrain fraud models, especially if you think about this world where there are agentic payments that are being powered by stablecoins. It's like literally my job at Venmo, in my previous life, is to train neural networks on bots. And so now actually the bots are not all fraudulent. They were before. So now what? So there's still a lot of work left. And so we had that was probably one of my favorite moments. Just like being able to jam with payments people and payments nerds on like the real problems of payments.
So not jamming with crypto people on layer 7s doesn't get you that excited. It's a shame. Sorry to hear that, sir. But Alana, I would love to dive into, since this is a podcast on Stablecoin Stats, I would love to dive into your report because I believe that the first section of your report is stablecoins. And so that works out very well. And it must mean that you're optimistic on the sector. And when I was actually going through this, I think one of the biggest things that resonated with me was you have a lot of good data on potential opportunities and challenges for stablecoins to really, explode to, $1 trillion, $2 trillion. I mean, we hear these like projections all the time. And I really like the slide here that you had about, interest in stablecoins. It's an all-time high with Google carries. And, we are growing. I think actually month over month was like quite flat with stablecoins. But I think that you brought up a lot of good points on, how these services will enable us to get to almost like 3 trillion or 5 or 10 trillion stablecoins. And I really like this one, this slide here about Turnkey and about how like their volume has absolutely exploded. I would love to hear your thoughts on, well, just first off, generally, like what do you think we need as an industry to get to, like these massive numbers? And then, would love to hear some thoughts on like Turnkey and embedded wallets and how you see that fitting in.
Totally. So at a high level, the motivation for putting together the stablecoin section in the report was really like, there's all this talk about stablecoins. It feels like it is very real and accelerating at an incredible pace. Let's try and put some numbers to that, sort of back it up, see if the data really supports it. Incredible and really exciting thing was it does. Like the data is overwhelmingly supportive that stablecoin adoption is happening faster than it's ever happened. It is accelerating. So it's growing at an increasing rate. That's backed up in sort of the interest, like the Google query interest. As you mentioned, it's also backed up in the hard numbers. When you think about where stablecoins are today, and I think the total circulating supply of stablecoins is sitting at around or just under $300 billion. $300 billion. Question is, how do you get to $1 trillion? How do you get to $5 trillion? How do you continue to grow from there? At a high level, my sort of view of the world is that all of the dollar deposits in the world will eventually be tokenized. And so when you think about the total addressable market for that, it is massive. As we get that shift from fiat to stablecoins, there's so many opportunities that exist just from the size of the market, 100xing or 1000xing. Question is, what benefits and what is the infrastructure that's necessary in order to sort of get us there? So what has gotten us, the question is sort of twofold. What has gotten us to 300 billion in circulating supply so far? And what are the pieces of infrastructure that we still need to get to the next leg and the leg after that of growth? Turnkey is a great example. So one of the slides in the report that for anybody looking at sort of the video version of this, there's a slide on Turnkey, which is an embedded wallet provider and sort of verifiable compute platform. They power a lot of stablecoin infrastructure. You can basically think of them as a digital wallet, just that connects to crypto rails and enables anybody to send or receive any type of digital asset. One of the major beachhead use cases is stablecoins. Why is that? It's because anybody with sort of access to payments, which is pretty much any business in the world, may need to think about this in the future. And so the slide, some of the stats on it is that Turnkey has experienced about 300% week over week growth pretty consistently in terms of stablecoin transfer volumes. Their peak transfer volume was in the billions of dollars, which is incredible. Typically, they're transferring hundreds of millions of dollars in USDC every single day. When you think about like the companies that use Turnkey under the hood, it's Bridge, which is a payment orchestrator. It's many payment service providers, so companies that are facilitating vendor-to-vendor payments internationally, payroll companies, expense companies, anyone that is sending money cross-border. It's just far easier to use stablecoins. It's faster, more liquid, and oftentimes cheaper. Turnkey is one of the pieces of infrastructure that powers that. It makes it so anybody can receive and send stablecoins instantaneously.
What kind of like, how does, like these wallet infrastructures, these embedded wallets, how do they like really like unlock it? Is it just ease of use for customers? Is it like, seed management? Like, what are the steps that, Turnkey, I guess like how best does Turnkey like enable like this easy onboard of users?
There's sort of two things that you can compare Turnkey to. One is a bank account. So how are deposits and payments typically done today in the fiat world? The other is you can compare it to the existing set of wallets in crypto that exist. I'll sort of go through each of those and why something like Turnkey is such a good option. So when you think about Turnkey relative to something like a bank account and how something like payroll might be done with dollar deposits, with payroll and sort of like a bank account in the traditional fiat system, what happens is payments are done in lump sums. It's often in like 2-week or monthly intervals. Part of that is because it is hard to reconcile between one bank versus another. It takes several days of settlement time. You oftentimes have to think about currency conversion if you're doing global payroll. Something like Turnkey, it is just faster and easier. You can stream payments daily. There is functionally zero cost to sending a transfer on chain. It is more open and transparent. And so it is easier to simultaneously sort of update the ledger and update your internal accounting systems of like, where's the money going? Can we track it? Can we see it in real time? All of that data that exists on top of the payments layer, you can have insights into when you use something like Turnkey. It's also because you're transacting in stablecoins, instantaneous. It can settle within 10 minutes, oftentimes even less than that. And you can sort of do the currency conversion in real time. So when you think about something like Turnkey relative to a traditional bank account, it's just a better form of like a dollar deposit in somebody's like digital wallet, whether that be on chain or off chain. Turnkey is just sort of an improvement in those terms, in those types of payment rails. Then you may say, but we already have wallets like something like Phantom, which we're investors in. We love the Phantom team. When you think about what that looks like, there's a bunch of sort of policy considerations that come in when people think about their internal accounting systems where something like Turnkey might actually be better. So in one respect, you can set up a wallet with just a few clicks of a button. You don't really need a long seed phrase. You can just use your email. You can have sort of a compliance system around these embedded wallets that differs from maybe what something like a MetaMask wallet looks like. Second, you can also start to set internal spend limits and create this additional policy layer engine on top of like, how do people spend in certain ways? How do we think about like who within an organization has access to certain types of assets? Can we create spend limits? Can we create sort of checks around before somebody goes and makes like $1 million purchase on something? And Turnkey is just a way to do that with a lot more efficiency on top of these new money rails.
So this is like, that's interesting. So it's almost like, because obviously, I was trying to spend, $1,000 this weekend on my corporate card, Anthony, to buy some Dom Perignon, but I was rejected for some reason, which was very upsetting. But it's almost like this is a different audience completely, where Turnkey almost kind of like unlocks like almost like sometimes like a business account where you can only like, have it settle for certain things at certain times and really, have guardrails on it versus like a wallet where you can literally do anything and everything.
That's such a good way of putting it. I think of Turnkey as really market expansionary for the set of crypto assets that can exist, where many of Turnkey's early customers are very crypto native, trading terminals like Axiom, prediction markets like Polymarket. And so they're really embedded in many of the leading crypto native products. But that has battle tested and hardened the infrastructure to enable them to also go and win major deals with traditional payment processing companies or fintechs that then, maybe they start out just using stablecoins and over time they want to incorporate other types of digital assets. But it is really market expansionary and part of how we get from 300 billion in stablecoins today to 3 trillion in stablecoins.
Yeah, no, I would love to get to 300 trillion. Anthony, I would just retire to a beach. I thought of you, Anthony, when I saw this slide. So we're looking at a slide now on the number of transactions that Blockaid has processed. And first, Alana, I'd love to hear about the Blockaid story and the founders there. But it seems to me now that since a stablecoin can do anything, now people like me now have just so many areas in which can go wrong with stablecoins in terms of fraud. It's not just now like fraud prevention, like, oh, did someone steal my credit card? It's just so much more than that. So I'd love to hear your thoughts on, how security comes into this picture of really like expanding the stablecoin market, and would love to hear, about the Blockaid team and story.
The Blockaid team is incredible. The founders, Ido and Roz, are some of the most sort of forward-thinking, sophisticated security actors in the space that I have ever met. They were leading researchers in the IDF. They won the IDF's top cybersecurity prize. And so they are just absolute geniuses. I can never say enough good things about this team, in part because one of the things that matters as we think about growing the size of the pie and growing the overall market for crypto and for stablecoins, just you need people to feel secure transacting. They need to know that they're not clicking on something that they don't intend to, clicking on a scam, or accidentally sending funds to somewhere that, they can't recover it from. And so Blockaid is really the critical piece of infrastructure that unlocks this larger market that gets us to many trillions in stablecoins. Specifically within the world of stablecoins, they cover a couple of different parts of the stack. So one of the key things is sort of fraud and compliance engines around how you think about transferring stablecoins. And I'll go into that in a sec. But one of the other things that Blockaid really does that I think is important is anyone at the issuance layer. When you think about how many stablecoins to issue, how are you making sure that they're ending up in sort of compliant wallets or compliant places? Blockaid is a policy and security engine around that. I don't know if you guys remember, a couple of months ago, I think PayPal accidentally minted several trillion PYUSD. That is actually a really big deal if something like that happens and it affects the way that people are transacting and updating their accounting ledgers. Blockaid can prevent something like that from happening. At its core, Blockaid does sort of smart contract scanning and is a whole security engine that sees into the operations of an organization and is a preventative measure to make sure that mistakes like that don't happen and that bad actors can't sort of manipulate the system.
Yeah, Anthony. Oh, sorry, Anthony. If you were at PayPal and your job at Venmo was, not only do you have to prevent card fraud, but you have to prevent every single financial transaction fraud, would you have still taken the job? And I would love your thoughts on, how does this is crazy, right? Because Blockaid needs to do so many things.
Since fraud detection is such a under the hood, you never really think about it when you make a Venmo payment or when you make a PayPal payment or Cash App payment. I think people don't understand the degree to which stablecoins now really enables fraud and theft. Not necessarily fraud, because the thing that they teach in computer security class is that with the internet, literally every hacker, maybe not literally, but every hacker is your neighbor, right? You have a direct access to everyone's computer because of the internet. And so you have the same analogy with stablecoins and the blockchain now, where it's literally you're connected maybe 1 to 2 hops away from every most sophisticated financial theft and fraudster in the world. And so it's a massive problem. And you can't just tack on a solution. As I mentioned earlier in the podcast, at least for existing payment systems, so I was heavily involved in Venmo's anti-fraud systems when we were building it. right? We have to retrain the whole neural network to account for this like new use case, because in the future, payments, right, as mentioned, like with agentic payments, like payments that are done by computers and bots will now not just be exclusively fraudsters, but also real users, right? And so, how do you differentiate the two? Who knows? So you have to look at like on-chain, not necessarily on-chain and off-chain signals to power your machine learning algorithm, and that's a lot of work. It takes many training cycles. It takes a lot of labeled data sets. It takes just like lots of mistakes, honestly, initially before you can train an algorithm to have like a high true positive rate. And so it's I would say like my biggest annoyance with agentic payments conversation now is like how little this stuff is talked about, and we're all just excited about X402, and like X402 is cool, but like it doesn't actually solve the how do we get to you know $3 or $30 trillion of stablecoin supply in the next 10 years.
When you think about what are the factors that go into fraud today, the inputs are often largely around, typical spend that a consumer or a user does. So is there sort of a purchase that is out of the norm? Are they transacting in a geography that they don't normally transact in? So if you live in New York City and all of a sudden you're transacting in Australia, that might flag something in the system. Especially if you're at the same time still transacting in New York, they may say like, hey, somebody has access to your information or your credit card that maybe they shouldn't. When you think about how that translates to the world of on-chain, much of that sort of existing fraud infrastructure breaks down in that you don't know the location of who's transacting or where they're transacting. There's not that same layer of identity. You can maybe start to look at things like what is the typical spend size, but because the set of things that people do with their wallets and the ways in which they transact on chain are so varied, like somebody could be using the same wallet to make a trade on Hyperliquid that they're also sending their friend like money for dinner. You don't have that same set of sort of signals. One of the things that Blockaid is incredible at, and I think one of the reasons they're such an important piece in building out this new fraud and compliance infrastructure around stablecoins, is they have this incredible clustering system where they can identify the flow of funds through different bad actors in crypto. They can see what wallets are typically typically interacting with each other. They have some wallets labeled. So like, for instance, if there is a major merchant, they know what the wallets are and they can start to incorporate that into the system. So if it is like a hub within the cluster, they may be able to say like, that's actually okay because we know this is like Shopify and they should be receiving and sending a lot of payments. But this other cluster that we've identified, which is largely how they do sort of security analysis today, may actually be a bad actor. And we want to double click into like what's going on there. We want to send some signals to the user and say like, hey, are you sure that this is what you're intending to do? And so that's one of the reasons why I think when you think about re-architecting this fraud and compliance infrastructure around what identity and data looks like in the world of stablecoin payments, Blockaid is such an important component to that.
Yeah, so it's like, even though we have tons of blockchain data and everything is on-chain, old like fraud models won't work at all. So we can't just take the work. I mean, we can take some of the work, I guess, that you did, Anthony. I don't want to throw all of your work aside, but it's almost like we have to start from scratch almost. And like we have all this data, but we have to not only start from scratch, but like expand the types of fraud like by 10x or so.
Exactly. And then in the world of sort of agentic payments, just to touch on the last thing that Anthony had said, when you think about the flow of an agentic payment, so like something that I am really excited about that I hope that X402 enables is, say I am like tracking my macros and I'm using MyFitnessPal, and then I also want to order food for dinner on Uber Eats. If I have an agent that I say like, hey, look at my existing macros for the day or my remaining macros and then go order me dinner on Uber Eats, the agent, maybe it pays a few cents to MyFitnessPal to access the data, incorporates that, and then goes and orders me something on Uber Eats. There's a ton of payments that are involved in that. When you think about that agent, though, interacting with the different websites, needs to make sure that the website isn't malicious or a scam. Blockaid has that as a core part of their screening technology today. The website needs to be able to say like, hey, we actually recognize this payment and we know that it's not coming from like a non-state actor. We can like feel comfortable accepting this payment. Blockaid has transaction scanning technology and sort of identification systems for that. And then you start to think about the whole flow. Like there's just so many more pieces that you can start to build out, very much to Anthony's point.
Yeah, no, that makes a lot of sense. And the last thing I wanted to touch on was Morpho obviously has seen, crazy growth in the past year or so. And one of the ways that, and you talked about, tokenized deposits moving on chain is like really going to be this catalyst for going to these, trillions of dollars. Here we're looking at is, total deposits in Morpho pool. And you really like see it accelerate after Coinbase launches direct integration. While it may have dipped a little bit, it's almost now up, more than 50% since, Coinbase integrated it. I'm curious your thoughts. Like first, like would love to get just a general overview of Morpho, but then, are these centralized players going to play like an increasing role in like really driving this forward, or do you think that like, how do these centralized exchange players, push this forward to where like we can now like anyone can really access Morpho?
So putting this in context of sort of the broader theme in the deck, which frames crypto's growth as a story of three compounding S-curves: asset creation, asset accumulation, and asset utilization. I think something like lending protocols, which Morpho is sort of the leading lending protocol within the crypto ecosystem in terms of net new adoption, that really speaks to the utilization S-curve for stablecoins. So we've had all of these stablecoins that have been created. There are many new issuers emerging on the market today. That's the creation S-curve. Something like Turnkey and something like Blockaid are helping with the accumulation S-curve, making it easier for people to get stablecoins in the hands of anyone, anywhere in the world and feel comfortable and safe transacting with them. Third S-curve is utilization. We're seeing some utilization on the payments front, which is really exciting. But really one of the major second-order effects of all of these stablecoins being created and adopted is utility within markets. Something like Morpho is an incredible example of a project and protocol that has benefited from the growth in stablecoins. As more people hold stablecoins just as the equivalent of dollar deposits, they want to put them to work. They want to earn a little bit of extra yield by supplying them in a lending protocol and letting people borrow against those assets. So instead of just having it sitting in a bank account earning like a fraction of a percent of interest annually, on Morpho, you can earn like 6 to 7% yield in a very safe and sort of low risk manner, which is really exciting. When you also think about what are the ways in which people want to like put those even more to work, you can borrow in stablecoins, and there's some interesting slides in the deck that suggests like here are the ways in which people are thinking about stablecoins similar to almost like home mortgages and access to more sort of market rates around interest mechanisms. I think one of the big things that has catalyzed Morpho's growth beyond just the fact that they are so sort of in tune to the stablecoin growth and stablecoin tailwinds is they've really targeted distribution through centralized exchanges and incumbent fintechs. A major theme of the report is that many of the new ways to create and utilize assets will be built on-chain and sort of pioneered on-chain, but then distributed through existing front ends. Like Coinbase is a great example, Robinhood, SoFi, Societe Generale, like many, many more. And that is where Morpho is focused on growth. How do we meet users where they are with their existing dollar deposits? If we anticipate that those dollar deposits are going to convert into stablecoins in the future, Morpho wants to be there and ready to help people put those assets to work. And I think that's really incredible.
So these like protocols should really be figuring out almost like how to either like get distribution or reduce friction, like by partnering with like centralized exchanges, Robinhood, or like going the almost like the turnkey route of like having a very easy to set up wallet where you can log in, you don't have to manage a seed phrase, and so that you can really just get distribution as quick as possible to grow as fast as possible.
Totally. I think you could very much envision a stack where it is Turnkey and Blockaid enabling a centralized front end to do something like borrow and lend on Morpho, where Turnkey lets you connect to the protocol and creates a safe place for you to then deposit your funds. Blockaid can make sure that you're not depositing into a pool with any sort of exploit or vulnerability. They can also make sure that a user is actually intending to borrow or lend against their assets, in that it just creates another sort of security and compliance check. And then the centralized front end just taps into Morpho once it has that other infrastructure in place. So it's really, really a holistic suite. And I think it's part of how we get stablecoins from 300 billion to 3 or 30 trillion.
Yeah. And the last slide I wanted to show here is the kind of the cost to borrow dollars. Now with these decentralized markets like Aave and Morpho, you highlighted here that they've actually, the cost to borrow is actually below the 30-year mortgage rate in the United States of 7.5%. I'm curious how you see this uncollateralized versus collateralized lending approach take into effect, because obviously Aave, USDC, Morpho, you have to post collateral to take out stable coins. Yeah, I'm curious, how do you see this evolving? If do you think in the future people will be able to easily take out less collateralized loans or under collateralized loans, or how do you kind of see this evolving in the future?
The set of ways to borrow against your assets is certainly a spectrum, and the slide shows the rates on something like Morpho versus the 30-year mortgage rates. Those exist on opposite ends of the spectrum, where something like a 30-year mortgage, you can get a loan for a relatively high interest rate, but you don't have to post that much collateral. So it's, to your point, Andrew, under collateralized. Something like Morpho, if you want to take out $1 million loan, you can oftentimes get a better rate than the 30-year mortgage, but the prerequisite is that you have more than $1 million worth of collateral to post. I think that something like Morpho is really incredible for people who already hold crypto assets and have a lot of their wealth on chain and are willing to put that to work in order to sort of borrow against those. The thing that actually inspired this slide was I have a friend who holds a decent amount of crypto, and he's developing real estate in California. So what he does in order to sort of help finance his build out of homes is he's very bullish on crypto and sort of a long-term believer. So he doesn't want to sell his assets in order to create liquidity to go buy the homes. He posts collateral to something like Morpho and then borrows against it to go finance the home, turns the homes into cash flow generating assets, and then repays his quote unquote mortgage on Morpho, which I think is really incredible. But of course, the prerequisite is that you hold a lot of crypto. In the middle of this spectrum, so 30-year mortgages on one end, Morpho on sort of the other end, is a whole host of things that you can mix and match. And so I very much anticipate a world in which we will see lending protocols start to incorporate things like off-chain credit ratings. Maybe some front ends or some specific pools will require KYC. And that is a choice that a protocol can make. And the way that they tap into crypto is just permissionless liquidity from anywhere in the world. It is a step function better than what exists today off-chain, that anyone in the world can still provide liquidity. It's just the question is are they comfortable KYCing? You can start to envision things like insurance playing a role as well against somebody that is borrowing against a volatile asset. One of the great things about Morpho is that they, again, are sort of this leading lending protocol in terms of generating a lot of adoption, but they're also a modular protocol. And so by utilizing crypto, they have turned a product into a platform, and we see a really impressive emergent developer ecosystem building on top of Morpho, trying to bring fixed rate lending infrastructure to the market, or some of these other under collateralized or unsecured lending structures as well. And so long-winded way of saying, Andrew, to your point, I think you're totally spot on that the way that lending exists today on chain is not the steady state of what it'll look like in the future. And there's still a lot of room for startup opportunities to come in and bring new types of user credit systems, especially as we start to think about many more people and many more types of institutions coming on chain, the full set of preferences that they'll have.
Do you think the lending the lending surface area expands? Like, do you think that Morpho will like accept like land or gold, or because it seems like now we're headed to this area where like like we talked about, like everything will become tokenized and that you could like lend against everything tokenized. Like, do you see a world in which just gets crazy where people can just, lend against anything?
I wouldn't use the term crazy. I think exciting in that today, high net worth individuals have access to some of these services where somebody may borrow against like a really expensive piece of art that they own. And that is a very narrow market and it's only accessible to a certain set of people within society. The question is, for any asset that somebody owns, if it is transparent, composable, and sort of accessible, how do you price the risk of borrowing against that? How do you think about the future value? I would almost flip the question on its head and say, like, why shouldn't you be able to borrow against more than just like dollar deposits? When you think about taking a mortgage on a home, you're basically borrowing against the home itself. And so when I start to think about what that looks like on chain, of course, there should be the ability to borrow against many different types of tokenized assets. And then the question just becomes, how do you price that risk and how do you manage the risk? And there's a whole ecosystem of emergent sort of risk managers that I think are really interesting businesses.
So you're saying lending against Pokemon cards is not in the next year or so?
Well, it's it's a really interesting question. You might not want to borrow against your Pokemon cards for, buying a home, but who knows? Maybe somebody wants to finance their like Chipotle burrito purchase with a loan against their Pokemon card, and that is like a nice coincidence of wants. That's probably not where we're headed. I think there's bigger opportunities to tackle, but one of the great things about crypto is that if somebody feels really passionate about that, they can build that.
That's true. I mean, PSA 10 Charizards, do go for quite a bit amount of money. My last question, Alana, is where are you? Yeah, since obviously you work at a venture capital fund, and where are you excited, and where are you looking for founders to pitch new opportunities to you? What areas in the stablecoin world?
So the way that I think about what's most interesting in stablecoins is stablecoin-enabled markets are really interesting to me. There's many opportunities to improve the existing way that stablecoins sort of get transacted today, from private transactions to new types of credit systems to like loyalty and rewards programs. My guess is that many of those actually turn into features adopted or pioneered by some of the incumbent payment service providers. And the opportunity for startups is create new markets that take advantage of these being super liquid, super composable assets. Couple examples of where this may be interesting is you could imagine non-USD stablecoins creating issuance around something like a Mexican peso, tokenizing that, and then building an on-chain foreign exchange market that helps facilitate cross-border payments in that way. You could imagine stablecoin orchestrators that help sort of make it feel like one stablecoin is composable with another. To a user, it should just feel like you're transacting with US dollars, but under the hood, there are ways that these stablecoins are actually like a little non-fungible in that the reserves or the sort of compliance policies or even minting and redeeming may differ. And there's a whole sort of market infrastructure and different set of exchanges that you can build to make sure that like one stablecoin feels like another to the user. I would say like those are probably the two pockets, and then all of the second order effects that come. So something like Morpho is a great example of a protocol that has benefited significantly from stablecoins. What are the other ones that are now uniquely well suited to grow or uniquely well suited to be able to be built because stablecoins exist? I think it's a good open question. I've got some ideas, but if you have any, please reach out to me because I love jamming on this stuff.
Pokemon cards. That's it. You heard it from Alana.
Maybe.
Stablecoin backed Pokemon cards.
Alana, last question for you. So we almost met nearly 4 years ago, and started talking about crypto, and a lot has happened since then. That was like March of 2022.
What? Did a lot has happened? I don't think anything has happened. What are you talking about?
Notwithstanding, we had a bit of our venture, our capital in some little bank called Silicon Valley Bank. And all the other things that are happened. So luckily we got everything back. As one knows. But love to hear some like reflections you had since we first met, almost like 4 years ago. I mean, yeah.
I think that many people view crypto as this very cyclical industry, very speculative. Price goes up, price goes down. There are these major boom and bust cycles. And really what I tried to do with the report was say like, hey, there's actually a method to the madness, how the underlying technology has progressed over time. And so, the price does go up and down. No one's sort of immune to paying attention to that. But there is a steady trend of ways that we can sort of underwrite like what's coming next in the future. The perspective that I take in the report is I think we still have some room to run in the asset creation S-curve. And, we have a lot of things left to tokenize when you think about putting all of the world's value on chain and sort of what that means. But where there's even more room to run is accumulation of these assets and then ways to put them to work. Crypto is the most composable, sort of open for experimentation asset class that has really ever existed. It is the first internet native money that we've ever had. And so, of course, there should be new ways to experiment with different parts of the asset lifecycle. The thing that has surprised me the most is probably like how fast the industry has recovered. And I think it speaks to the resiliency of the builders and many of the real sort of underlying fundamental technological progressions that do exist. Like I wouldn't be here if I didn't think crypto was a really productive force for the world and really truly making people's lives better. We don't always see that if we're in the United States where it's very easy to pay with a credit card and get access to a bank account. But there are many people around the world that rely on crypto for many meaningful parts of their life. FTX was 3 years ago. The industry, when you think about like the chairman of the SEC, Chairman Aken, coming out in like July of this year and saying like, we're launching Project Crypto. We're going to figure out a way to make the US the home of digital asset innovation and tokenization. That to me is really impressive because I think any other industry in the world you could look at and say if something like FTX happened, it'd be over. Like it'd be done. And it didn't, like in the grand scheme of things, it didn't take that long for crypto to recover. And that to me is really exciting. And it just speaks to like the fact that there is a real global innovative force behind this industry. So probably an optimistic take on the set of things that surprised me. When I joined, I also wasn't expecting FTX to collapse. So that was a surprise too. So you can sort of take it both ways. My hope is that we don't get anything like that in the future and that, this set of real world use cases or just the set of use cases in general that people are using crypto for continues to expand and grow in ways that we can predict and then hopefully some ways that surprise us in good ways as well.
I love the awesomeness. I really do. It's a fun time to be in crypto, especially with stablecoins taking off. And we're happy to have this podcast. Well, thanks so much for joining us, Alana. Where can people find more about you?
So you can find the full report in my pinned tweet on Twitter, Alana D. Levin. You can also find the full report on the Variant website, variant.fund. And then I write a blog that covers some of these topics and then just some other topics in crypto as well at backoftheenvelope.xyz.
Ooh, that's a good one. And then Anthony, where can people find more about you?
Yeah, I am at Anthony Yim, my full name, on X or formerly Twitter. And obviously you can find Artemis at Artemis.
Thank you very much, everyone. And if you haven't already, please subscribe to Tokenized on Apple, Spotify, or wherever podcasts. Finally, if you enjoyed this and want more, leave us a review. It legit helps us others find the show. Stay stable, everyone.